In recent news, stocks have been tumbling this week. Investors are on the edge of their seats, hoping that the upcoming earnings season will revive the year's banner rally. Plummeting stock prices are causing a stir in the financial world. The recent downturn is casting a shadow over the stock market, which had been on a tear for the better part of the year, with the three major U.S. indexes notching repeated record highs. This impressive performance seemed to continue the momentum of an already robust 2023. Yet the tide has turned, and investors are now holding their breath as the market shows signs of faltering. However, all hope is not lost. Analysts, as polled by FactSet, expect the first quarter earnings of S&P 500 companies to grow by 3.1% from the previous year. If this projection holds true, it would mark the third consecutive quarter of earnings growth. Additionally, full-year profits are expected to swell about 10.7%, further bolstering optimism. Despite the stock market's recent stumbles, some traders are holding on to hope, crediting strong fourth-quarter corporate earnings and a resilient economy for fueling optimism. They believe that the U.S. will dodge a recession, keeping the market surge alive. But this optimism has been challenged. Stocks started to tumble after notching their best start to the year since 2019. The S&P 500, for instance, has fallen 2% this week. This downturn has been fueled by hot inflation data and warnings from Federal Reserve officials, which raised concerns that long-awaited rate cuts could come later than expected. Elevated bond yields and spiking oil prices are also weighing heavily on stocks. Yet, there's a glimmer of hope. Some investors believe that the first quarter earnings season could reignite the stock rally. They argue that if corporate earnings continue to climb, it could catalyze the market's resurgence. Despite the strong start of the year, stocks have begun to tumble, raising concerns among investors. The upcoming earnings season could be a pivotal moment, potentially turning things around or confirming the fears of a market downturn. A variety of factors are impacting the stock market at the moment, from hot inflation data to warnings from Federal Reserve officials. These elements, coupled with others, are significantly influencing the attitude of investors and the overall performance of the market. Firstly, let's talk about inflation. The current inflation data is hotter than a jalapeno in July, and it's causing quite a stir in the market. When inflation is high, the purchasing power of money decreases. This means that the same amount of money can buy fewer goods and services than before. For investors, this translates to a decrease in the value of their investments and, consequently, their returns. The result? A downward pressure on the stock market. Now let's move to the Federal Reserve. The Fed's warnings have been as subtle as a sledgehammer. They've been hinting at a potential increase in interest rates, and this has led to a decrease in expectations for interest rate cuts. Remember, when interest rates are high, borrowing becomes more expensive. This can discourage companies from taking out loans to finance growth, which can slow down economic activity and negatively impact the stock market. But that's not all. The market is also having to grapple with elevated bond yields and spiking oil prices. Higher bond yields mean that bonds become a more attractive investment option compared to stocks, leading to a shift in investor preference and a possible downturn in the stock market. And as for oil prices, when they rise, it increases the cost of production for many companies, squeezing their profits and potentially causing their stock prices to fall. So you see, all these factors, inflation data, Federal Reserve warnings, elevated bond yields, and rising oil prices, are like the four horsemen of the stock market apocalypse. Each one on its own can cause some disruption, but together they're a formidable force. These factors have all contributed to the current sputtering of the stock market rally. With the first quarter earnings season just around the corner, many investors are hopeful that it could provide the boost needed to revive the stock market rally. This optimistic sentiment isn't unfounded. Analysts predict the first quarter earnings of S&P 500 companies to grow by 3.1% from the previous year. This growth would mark the third consecutive quarter of earnings growth, with full-year profits swelling to an expected 10.7%. However, the stock market has been on a roller coaster ride lately, with stocks tumbling after reaching their best start to the year since 2019. Factors like hot inflation data and warnings from Federal Reserve officials have raised concerns that long-awaited rate cuts could come later than expected. Elevated bond yields and spiking oil prices are also weighing on stocks. In the midst of this turbulence, the upcoming earnings season could be a beacon of hope for investors. Matthew Stith, the director of equity research at Bartlett Wealth Management, believes that if corporate earnings continue to move higher, that could provide the catalyst for the market to keep working. In other words, strong earnings could signal to investors that the economy is resilient and that companies are thriving despite the headwinds. The earnings season will kick off next week with quarterly updates from heavy hitters like Delta Airlines, Citigroup, BlackRock, JP Morgan Chase, and Wells Fargo. Investors will be keenly parsing these reports for clues about the state of consumer spending, which is a crucial indicator of the economy's health. However, it's important to note that the picture isn't uniformly rosy. As Young-Yu Ma, Chief Investment Officer at BMO Wealth Management, pointed out, the earnings season is likely to reveal a bifurcated market. Many companies are thriving, but an increasing minority are struggling. This situation reflects the mixed picture of the economy's health. With the earnings season kicking off next week, all eyes will be on the market to see if the rally can be revived. While some are hopeful about the upcoming earnings season, others are casting a wary eye on the health of the economy. The picture painted is a mixed one. On one hand, consumer spending, the lifeblood of the economy, has been strong. This spending has been buoyed by a resilient jobs market, which has managed to hold firm even as interest rates hover at a 23-year high. Yet there's a sense of unease that's permeating the air. Americans' attitudes towards the economy have soured. Lower-income consumers in particular have tightened their purse strings, reining in their spending. This dichotomy of strong consumer spending coupled with a souring mood is indicative of the uncertainty that's currently characterizing the economy. This Friday, Wall Street will be holding its collective breath as the latest jobs report is released. This report could provide a clearer picture of the economy's health. Economists are projecting that the U.S. economy added 200,000 jobs in March. The actual numbers, when released, could either confirm or dispel the clouds of uncertainty that are currently hovering over the economy. In the midst of all this, the earnings season looms. Investors are hoping that strong earnings will provide a much-needed boost to the stock market. If corporate earnings continue to rise, this could serve as the catalyst that keeps the market chugging along. However, it's also essential to remember that the stock market does not exist in a vacuum. It's intrinsically linked to the health of the economy. As such, the state of the economy will inevitably impact the performance of the stock market. This interplay between the stock market and the economy underscores the complexity of the financial ecosystem. So, as we look towards the upcoming earnings season, it's crucial to keep the health of the economy in mind. The stock market may be a roller coaster ride, but it's the economy that provides the tracks on which it runs. The health of the economy remains a crucial factor in the state of the stock market. As we look ahead, the outlook for the stock market remains uncertain. It's a bit like trying to predict the weather. There are so many variables in play, and each one can dramatically change the forecast. For instance, let's consider the views of Young-Yu Ma, Chief Investment Officer at BMO Wealth Management. He suggests a scenario that might seem paradoxical at first glance. He sees a bifurcated market on the horizon, where many companies continue to thrive, while an increasing minority struggle. In other words, it's not a tide that lifts all boats. Some vessels might be left stranded or even sink, while others sail smoothly. This pattern, if it materializes, could have several implications. For one, it could lead to a widening gap between successful and struggling companies. It could also create opportunities for investors who can spot the winners and steer clear of the losers. However, it also adds a layer of uncertainty and complexity to the investing process. Moreover, it's not just about individual companies. Broader economic trends can also sway the direction of the stock market. For instance, the health of the job market, the level of consumer spending, and the impact of inflation are all key factors to watch. These elements can either boost or dampen investor sentiment, influencing the market's trajectory. But let's not forget the role of the Federal Reserve. Its decisions on interest rates can have a profound impact on the stock market. Any hint of a change in monetary policy could send ripples through the market, causing stocks to surge or slump. In the end, the future of the stock market is a bit like a puzzle. It's made up of many pieces, each one important, and it takes time and skill to put it all together. It's a process filled with both challenges and opportunities. As we continue to navigate these uncertain times, the future of the stock market remains a topic of much debate. But one thing's for sure, it will continue to be an exciting ride, full of twists and turns, ups and downs. So keep your seatbelts fastened and stay tuned for the next episode of the Stock Market Saga.